Hey, thanks everyone for joining us tonight. I have Mark Sebastian with me here online in the virtual option trading world. And Mark is one of the co-authors of a fairly recently published book called The Option Trader's Hedge Fund. If you haven't picked up a copy of it, I encourage you to do so. The topic tonight is going to be on building and executing a trading plan. This is kind of foundational stuff for anyone who plans on actually making money over any significant period of time in the market. And with that, I'm going to turn the reins over to Mark and let him get started with the presentation. So let me change our presenter here. And Mark, you should have the controls now.
I see him, and I'm excited to start. Hi, everybody. How's everybody doing? Good to be here. Good to be alive. It's a lovely evening here in Chicago. It was almost 70 yesterday. It's just in the high 50s today, but that's still crazy for early December. My name is Mark Sebastian. I'm the Chief Operating Officer of Option Pit. Also do some derivative research and consultancy, and we'll see in the next couple months about a couple other things that may or may not come out of the woodwork. But primarily we're going to talk about my role at Option Pit, which is as a trader who teaches. Sometimes called an educator, but I prefer trader who teaches. And we're going to talk about principles of risk management. So I have not done this presentation for this group. I've done it, I think, two other places. I always change it up a little bit, but I think it's a really good foundational approach as to how to build a trading plan. Our book kind of digs into a lot of this more. We'll talk. All right, we'll talk. So today what you're going to learn is what is risk management, where to start. We're going to talk about money management, portfolio management, and position management, and then I'll briefly talk about portfolio insurance. All right, what is risk management? I always thought this was funny. I went into Merriam-Webster online and typed in risk management into the dictionary, and it said, the word you've entered isn't in the dictionary. Click on spelling suggestions. So I thought it was kind of funny because there's no official definition of risk management. I think as a trader, I would define it this way, all right? The taking of risk in the most capital efficient manner as such to receive the highest possible return for the fewest amount of dollars, all right? So that sounds awesome, right? I mean, if it was that simple, we'd be done here. But the how, the what is easy. It's the how that becomes more difficult. This is something Dennis and I kind of wrestled with in the book. How do we approach this? And we'll talk a little bit about that now. So first is understanding risk. This is the very first part. Now, before you read my book. It's funny, I always tell people, my book is not the first book you should pick up. It's probably not the second book you should pick up. It's maybe the third or fourth, all right? But it's definitely a book you should pick up before you pick up one on, let's say, a specific strategy. I would say once you figure out how options work, that's when you pick up our book, all right? And really, the first key to understanding risk is understanding what you're dealing with. Before you fly a plane, if you're going to be a pilot, there is extensive classwork as to how lift works with the wing, how the steering wheel works, how everything works. And then you do tons of time in the simulator. Why? Why? So when you're flying for the first time, You're prepared for what could happen, understand what is happening, and why it is happening. You know, the first key to being good at risk management is understanding the risk at hand. Okay? The first way to get over your head is to not understand what your actual risk is. That is how people blow up. They don't understand the risk. So where to start? Number one, understand the instrument. All right? How is a future different from equity? How is an option different from a future? Learn the working of the instrument intuitively. Intuitively. Now, if I ask you, what does that? What does to you guys? What does the working of something intuitively mean? What do you guys think? What is the working of an instrument intuitively? I don't know if Chris is, he had to let his daughter in.
Oh, God. Rod says you can visualize it. Andrew says you can understand.
Yeah, I think that's a good way.
Yeah, Andrew says you can understand all the concepts clearly without having to reference a book.
Yeah, I would say it goes to the point where it's second nature as to starting a car, driving, you know, turning the wheel a certain way, turn the wheel right. But yeah, you don't have to think about things to know things. Okay? When I look at options, and to a lesser extent futures, I don't need to. It is all second nature, and so I think that's the key. Is you should understand things second nature. All right. So that means you need to immediately know the process is how does one read an options quote? How do options price? How do option synthetics function? How does the pricing model work? All right. How do the Greeks function as an output of the model? What are the non-modeled risks of options? All right. These, if you can't go bing, bang, boom, boom, bing, bang, and get through and basically know this. Now, the last one might be tricky. You know, even I have to sit down and look at a position and go, well, what are the potential risks beyond what the Greeks are telling me? But I know what to look for. All right. Understanding options at this level, where all of these are second nature. This is where you need to get before you even start trading. I can give you a way. I'll let you tell you what. I'll let you start trading mildly, certainly not like a hedge fund, without getting the non-modeled risk. All right, but beyond that, no way. Nothing beyond covered calls and short puts, and maybe collaring. All right. Does anybody have any questions about any of these steps? It should be pretty simple. Learn to read the option quote. Learn how options price. Learn how option synthetics function. That should say function, not functions. Oops. Excellent, went backwards. All right. Learn how the pricing model works. Black-Scholes, binomial. You know, all the inputs and outputs. All right. And now understand the Greeks. You know, a lot of people can tell you what the Greeks are, but they don't really understand how they work. And then obviously, finally, non-modeled risk, and that's the most difficult one. Why do I need to know this? Charts are nice. They really are. But they're built on models. All right? Modeling does not always work. All right? And if you don't understand what the model is working, you will not understand what could potentially change. All right? one doesn't understand how the model works, one cannot accurately manage risk. You can't. All right? Because the model will change the Greeks on you. There's nothing like, you know, everybody ever heard of like, you know, you see some sort of like evil game where the overlord changes the rules when like the hero is starting to win? That is kind of how the pricing model works. All right? You'll think you're winning, and then one of the inputs in the model will change, and the Greeks will all change on you, and all of a sudden you look and go, what the heck just happened? That is why you need to understand the pricing model. All right? Now, that doesn't mean you can't eventually get to shortcuts. Shortcuts are fine. All right? Everybody has them, myself included. But, you know, you got to learn to do a layup before you learn to dunk. Okay? You got to learn to shoot free throws before you learn to shoot three-pointers. So, you know, that's the key. All right? Learning this stuff, you know, one of the things, my sister was really, really good at basketball. I'm not. Mostly because she's a girl and I'm a guy and she's the same height as me. Plus, she's athletic. And, you know, she used to go out and shoot 100 free throws every day. Learning, if you want to get good options, if you want to make money trading options, you got to go out and do your free throws. All right? Then learn the shortcuts. Once you learn the shortcuts, then I don't care if you look at a chart or a pricing graph or a risk graph. All right? Understanding the cause of risk is the key to managing risk. I'll say it one more time. Understanding the cause of risk is the key to managing risk. All right, one more thing. Understand the contract you are trading. All right, you would be shocked at the number of people that didn't understand that the VIX was not a regular expiration. Or I'll meet people that trade SPX for some time and don't understand that it's a cash print on the open. They don't know the multipliers on the commodities they trade. They don't even know what their option expires into or when it expires. It is crazy. One would think it is simple, but it is not. All right? It really isn't. You would be surprised. All right? You know, lots of people trade gold. How many troy ounces is a gold future? Well, then your answer should be that depends. Are you talking about the big contract or the mini contract? Big contract's 100. You know, oil, 5,000 barrels. The S&Ps, the mini is a 50 multiplier. The big is a $250 multiplier. You know, meanwhile, the SPX prints into cash, while spiders print into the stock. There are a lot of different things that can change about options on you guys. You got to know it before you trade it. All right, now let's talk money management. All right, once the trader is actually ready to trade, the next step is to build a money management plan. All right, a money management plan will allot for how much of an account will be engaged in the market and how much money is allocated as it is engaged. All right, we run a strategy letter at Option Pit. We run a daily strategy letter, all right, where at any given time we're managing between 5 and 15 trades. The account was $15,000 that we started with. All right? How much should each trade be? That was and how much should we put into the actual market? That was a set of questions we had to answer. And we literally sat there and wrote out a plan. All right? What kind of money do you have to work with? I mean, obviously, that's the easy place. All right? What is your goal rate of return? All right? What is your goal? If you have a moment after this is done and you want to see a fun presentation, I think, Chris, do you have the one where I talked about realistic expectations archive?
Yeah, I'm sure that I do.
Yeah.
And
that is a fun one to, if you want to talk about realistic expectations, I think that's a good one to kind of discuss, because I go through kind of what is and what is not realistic. Now, how can you allocate capital so that you are able to achieve that rate of return? All right? Can it be done without risk of a blow-up? All right? Is the plan efficient? All right? And does the plan scale? And this is the one that gets people a lot. All right? And now I'll talk about each of those. Capital. Different accounts warrant different approaches to trading. All right? Do not, and this is a big one, guys. I implore you, do not treat any capital lightly at all. All right? All capital is a part of building success and wealth. All right? There is no such thing as throwaway capital. All right? Treat every dollar as if it matters. I mean that. All right? You don't know how often I get people that say, oh, it's just a $5,000 account. Oh, it's just a $6,000 account. Oh, it's just a $10,000 account. And, you know, I always laugh, because if I went up to them and asked them for $1,000, and I said, yeah, it's just $1,000, can I have it? You know what most of those people would say? Absolutely not, you jerk. Or you know, maybe something ruder or less rude, depending. I mean, I'm pretty rude for asking for $1,000 from a complete stranger, but hey. So, you know, one of the things I always like to talk to people about is what you can buy for $6,000. And here's a couple of examples. You can get a 1973 Jeep CJ 4x4 for $5,900 or best offer. All right. Now, another pair of shoes is you can get a pair of BNIB 100% authentic Christian Louboutin Daffodil 160 in Meridian Blue Strauss size 38, new with the box. All right. And that's only $5,500. All right. You would have that to spare. Now, before you say, who would spend $5,500 on a pair of shoes? I can promise you this. If my wife saw a pair of Christian Louboutins that she really wanted, and they were $5,500, all right? And in my left hand, I had a stack of 55 $100 bills, and in my right hand, I had that pair of shoes, all right? She would probably take the shoes. In fact, it would be a no-brainer. So anyway, think about that. All right, ask your friend or significant other. What would you do with $6,000 if you didn't throw it away into a trading account? That's a pretty sweet bedroom set, $6,000. Well, maybe not the entire bedroom set, but it's some nice stuff. So I want you to think about that. I think people will pay that much money for a stupid red heel, by the way. Just saying. All right, now, return. And this is the only slide I'm going to talk about that. All right, be aware of what's realistic. All right, a 5% a month annual return equates to about 80% a year. All right, compound it. Obviously, simple, it's 60. A 2% rate of return equates to about 26%. You know, you have to be realistic. That's really important. All right? And new traders, more often than not, think they can get this number right away when they should be begging for this number. Because this number, the 80%, is not easy to get. Okay? So be realistic. Having the right expectations will stop you from, you know, executing poor risk. It really will. All right? And maybe and the other thing is your risk profile might not fit an 80% return. Allocate capital. All right? How much of an account should stay in cash? All right? What is the target return on traded capital to achieve the trader's goal rate of return? All right? Ceteris paribus, how should capital be allocated into each trade to achieve the target rate of return? All right? Assume the same target rate of return for every trade. All right? Allocate trading capital across trades. Everyone know what ceteris paribus means? It means all other things equal. It's a big economist term. They love it. All right? So basically all I'm saying here is how much of your account are you going to keep in cash? You should keep a chunk. All right? Based on your target rate of return for your whole account, what do you need to return on your traded capital? All right? Then look at the strategy you want to trade and look at what's a fair return for each strategy and allocate so that you can kind of get the same rate of return for every trade. All right? Then allocate trading capital across trades. Risk of blow-up. When allocating capital, one common mistake is too much of a good thing approach. All right? Oh, I love iron condors. Oh, I only sell credit spreads. I trade calendars. I do this. I do that. All right? All right? Traders need to be diversified. Be aware of the risks of their long-short premium. All right? Aware of their maximum loss in a catastrophe. All right? Take appropriate steps to ensure that one is always able to trade. All right? And never be net short contracts or units, as we'll say. All right? Always keep some cash. You should never be in a situation where you're not able to trade. That is very bad. All right, now, once the money management plan is in place, make sure to evaluate the plan after its completion. Is there too much concentration on one short premium spread or another? What is the net vega exposure? Is there enough long realized volatility exposure, sometimes called long gamma? Is there enough cash? Is there enough insurance? You know, I'll tell you, the plan that Andrew and I run on our strategy letter, our net Greeks on our portfolio are usually somewhere close to zero. We almost never have delta. almost never have vega, we almost never have gamma, and we usually have very little theta. We really do a lot to make sure our risks are not in any, we manage our risks. And you should do the same. Once you write a plan, you should be going back and evaluating it. Not just right as soon as you start, but as you're trading it, as you're through it. Is it scalable? This is the key question in money management. A real trading approach should be planned for $200,000, not $20,000. This is why it's so important to be a realist. If it doesn't scale, it doesn't work. If you wouldn't do your trading approach on a $100,000 account, you probably shouldn't do it on a $10,000 account. I don't always agree with everything the Nigerians say, but the one thing Dr. J said one time that was really good was retail traders, the kind of risk retail traders take time and time again would get any professional trader fired. Seriously. All right? That you got to think scale. Super important. All right, now that we've talked about money management, all right, the trading plan. This is the nitty-gritty of our capital allocation. Again, it assumes all trades are tradable, but not spectacular conditions. All right, so there will be periods of time where one trade looks better than another. All right, there are times where butterflies are better trades than condors. There are times where back spreads are better trades than both. There are times where short and long time spreads are better than both. All right, so then you allocate capital to each trade in the plan and then adjust the size of the trade according to conditions in the market and actually how much you already have in the market of one particular trade. I need to add that bullet point in. Put into place restrictions on losses and target gains. Covers adjustments, strategies, and insurance. Sample allocation, $100,000. Target return, 2%. Cash or cash equivalents, 50,000. Trades on return, 4% on dollars traded. You got condors, butterflies, time spreads, back spreads, VIX-based trades, units, cash held back for adjusting. Actually, I think I went in and broke it down a little more. All right. Condors, condor equivalents, cash in $4,000, cash collected $2,000. All right, this is perfect, right? Butterfly, cash in $16,000, cash collected $800. Back spreads in long gamma, cash in 0, cash collected $350. Calendars, cash in 0, cash collected $800. You're saying, wait, calendars, cash in. Notice I don't say just long calendars. All right? The way we trade calendars, come on. The way we trade calendars, very rarely are we just long. And if we are, we've got, we've got something else against it. VIX-based trade, cash in, cash collected. All right, units, just insurance. Maybe you throw out $1,000 just to make so you can sleep at night. Net cash collected, $3,650. That is a monthly return of 3.65%. 3.65%, you may ask, because none of those trades work 100% of the time, or even 80% of the time. We need to assume many things. We will have losing months. We have months where we don't hit targets. We'll have months where we have to make adjustments to positions that reduce profit potential. Okay? You got to think about that stuff. All right, finally, adjust allocation according to what trades are more or less favorable. And again, how much of one trade you have on. All right, if butterflies are statistically more favorable than time spreads, you should be weighted in butterflies. If condors don't look good, you don't trade them. Cash is a position. I ran a blog on the website where I ran a real simple rate of return. And in one portfolio, I ran a trade every month, just randomly picked some numbers. And in the second portfolio, all I did was drop the second best month and I believe the second or third worst month. And my return went up. Now, that may not always be the case, but my point is that avoiding losses is as important as hitting wins. Trade plan. All right? What is the most important part of managing the risk of a trade? The best risk management is good trades. Good trades make risk management easy. This goes back all the way to the beginning about learning how options fundamentally work. If you learn how options fundamentally work, strategy overlay actually becomes much, much easier. I see people bash their heads trying to get some sort of butterfly or time spread or condor or credit spread strategy to work, and where they could have spent half the time they did trying to figure out how to make a good plan by spending an extra couple of weeks really learning options, or a couple of months. All right? So you enter good trades by understanding the best condition for each trade. This is something we actually cover in the book. All right? Then you build an adjustment plan around it. Keys to a trade plan. Write up the optimal conditions, normal conditions, and no trade conditions. Write up an adjustment plan for any potential conceivable move. Underlying rallies, IV down and falling. Underlying rallies, IV up and rising. Underlying falls, IV is up but falling. There's all sorts of combinations. You should have kind of a plan for each of those. Don't have to specifically write down each of them. It's good to write up at the beginning, but not every month. You don't need to sit there and say, what's my plan with this trade? Just write up kind of how you're going to approach every trade. Set a maximum loss for each trade. This is the level the trade is pulled. Set an absolute max loss. Now, this is a concept I really like. Absolute max loss. All right? This is a level that a trade will never be allowed to fall to under any reasonable scenario. All right? So for Condor, maximum loss might be the same as the target profit. All right? The absolute max loss might be the total cash collected. All right? Why two max losses? One of the hardest things for traders to deal with is when a trade is down but not at a maximum loss. Typically, they will not adjust or they'll stay in overnight. That's when people blow up usually. Or they really get themselves in trouble. if absolute maximum loss is within 1 standard deviation, the trader should adjust regardless of max loss. It will save you money over time. You will see a lot of trades just turn around and go back, but you will net be happy that you did that. All right? For every trade, there's likely some variant of adjustment that is going to work well. However, there are some important keys to adjusting that will help ensure one's account doesn't blow up. We see more blowups from bad adjusting than bad trades. Close cheap shorts always. Alec Baldwin always says ABC. Always be closing. You should be doing the same. All right? I'm telling you, I have seen there are so many guys out there that teach these that don't know what they're doing, that teach like these triple butterfly approaches or these rolling iron condor approaches, and I've seen more accounts blown up on triple butterflies and rolled iron condors than I have, and added time spreads than I have on just about any type of adjustment. I mean that. I like this as my third rule. This is very simple. Set a max loss. When you have a third of max loss, make an adjustment to reduce risk. I usually try and cut my deltas in half without increasing my gamma. All right? When you're at 2/3 of max loss, make a second adjustment. Again, I'll try and cut my deltas in half without increasing my gamma. All right? When you're at 3/3 of max loss, kill the trade. Simple, easy, breezy, beautiful, cover girl. Adjusting. All right? Never throw capital at a trade. The idea that simply adding a butterfly or calendar is wrong. All right? Rolling and increasing size is also typically a mistake. All right? When you're adjusting trades, try to add as little capital as possible. Keep return targets and maximum losses off of the original trade. Do not add in the adjustments. All right? Never open up a cheap option. What I find open up, I mean sell a cheap option or buy a cheap option that you don't already have open. Try and stay contract neutral. All right? You will find that if you make adjustments and you don't add total contracts to the trade, and by that I mean I'm in a 5-lot butterfly. That is 20 contracts. All right? Maybe I bought 2 calls to flatten the delta. That is a net 22 contracts. My goal in adjusting would be to be as close to 22 contracts as I possibly could be after my first adjustment. Insurance. All right. Insurance, I think, is important. All right, I'll give you 2 stories, different outcomes. First story is Apple. I was talking to some guy after a seminar I did, and here's what he says to me. I just go out and I sell really wide strangles on Apple. What's wrong with that? How can I get hurt on that? And I told him, I said, it's not within my risk profile, right? And then Apple made its big move higher, and he went from somebody trading portfolio margin to somebody that stopped trading, right? Elan, I've told the story a couple times. I was trading it. I just bought back some cheap puts that I was short, and because of that, I made. I walked in one day. The stock was off 88%, and I made money on it because of that. So you need to make sure you protect yourself. For starters, always be net long or at least flat teenies or units, cheap options. At least be flat. preferably long. And buyback, I'm telling you, buyback options worth a nickel or less. I promise you, you'll be happy. All right, now, insurance is inherently overpriced and almost over time not worth it, really. But we buy these so we can sleep at night, not because they're a good value. A well-executed portfolio might not need that help if you're like our strategy letter that does not carry units because it has net zero Greeks. That is a different story. But if you're going to want to be one of these crazy I sell premium people, you should probably consider carrying a little bit of insurance, especially when the VIX is cheap. So summary, there are a lot of keys to risk management. Starts with knowing what you're trading intuitively, and then it moves to a money management plan, trading plan, and then a trade plan. And don't be net short the teenies. So if you want, you should buy my book, and I'll tell you why you should buy my book. One, it's a good book. Two, in one of the appendixes is a free month of my Option Pit live service. All right, so a free month following our strategy letter, listening to me talk every day. Hey, if this was horrible for you, you may not want to buy the book. So it's I think a good book. I really do. I wouldn't put my name on it if I didn't think so. Two, comes with a free month of our service. The book is about $38. My service is $125 a month. And then finally, by clicking on theoptionclub.com/Sebastian, you're supporting Chris, who brought you this webinar for free. You know, he just gets to wet his beak a little bit on these books. And I encouraged him to set up a link for this because I wanted him to support it. All right? And if you buy the book and send it to me, I'll get Dennis is going to be in town sometime in the next couple of months. He and I will sign him for you too if you want. And I don't know why you want my Herbie Hancock, but you can. All right? Incidentally, if you want to take my silver course, which is normally $149, and you use code OCOP, you can buy the silver course for the closing price of the VIX today as well. But seriously, go out and buy the book. Do we have any questions?
Hey, Mark, real quick, why don't you explain to everyone what your what the service is that you're talking about in terms of...
Yeah. All right. So Option Pit is an education bit. We're in the education business. All right. My gold course, which is $19.50, is the equivalent of what you will learn at other people's mentoring services, and you'll end up paying $5,000, $6,000, $7,000. You will learn that much. All right. We always give a discount to Option Pit or Option Club students. So if you tell me that you found out through the Option Club, I'll discount it something. And then our Option Pit Live service is a daily service that comes with each of our coursework. Each of our coursework comes with this service. All right. You can get one-on-one work, which is what we suggest if you're going to get really, really serious. But we want everybody to take Gold course because it's just that good. It's about 45 hours of education, and it's in-depth. The live service, then, is a daily 45-minute discussion where me and Andrew, one, talk about what we're trading in the strategy letter. All right? Here's what's been happening. Here's what the current trades are. Here's what our plan is. Then we spend the next section talking about the markets. And from there, we whittle down into possibly trading opportunities we like. And if we really like something, we'll add it into the strategy letter. All right. We also take questions and look at stocks that people want us to look, and we'll do some troubleshooting there as well. The strategy letter is shot out via email. It's updated 4 to 5 times a day. Now, one clear thing about the strategy letter, it is not a newsletter. It is an educational letter. We are designing it to be especially low risk, all right, and educational. All right, we do want it to make money, obviously, because Andrew and I often have many of those trades on. So we do keep track of the P&L, and you can see it when you look on the stuff, but we don't market it as a newsletter, specifically because we want it to be we're big believers in the teach a man to fish.
All right, so Ray's asking, what is the difference between ETFs and ETNs?
What is the difference between an ETF and an ETN? An ETF is an exchange-traded fund. An ETN is an exchange-traded note. A note is actually represents a credit, all right, whereas a fund actually holds something, all right? So the ETF actually holds the physical. So GLD is an ETF. In theory, it is supposed to be holding the physical. All right, maybe doing it via futures. It may be doing it via owning bullion. We don't know. All right. The CORN, C-O-R-N, I believe is an ETN, and it represents a credit security that represents the holdings of what the kind of target of that ETN is. So VXX is a famous ETN that is really, really poorly executed and has lost 98.5% of its return. All right, so that's the big difference. You'll hear Bill Luby just call them ETPs, which is exchange traded products. But in the end, you can exchange your ETF in and actually get whatever it's supposed to represent. You cannot do that with an ETN. It is basically a bond. Does that make sense?
Well, it did to Ray, so he was the guy who answered the question or asked the question, so he's happy.
There you
go. Dave's asking, what level of trader benefits from your service?
We have everything from beginner all the way to, I have a group of professionals that I manage, that I work with, who are managing, anywhere from a couple million. My biggest client manages about $15 billion. That's with a B. And I also have my beginner stuff. We designed our silver and gold courses to take a trader who wants to learn what they need to know in order to potentially become successful. So it is meant for every single trader. By the time, consider my gold course or the organic chemistry of everything. All right? So if you can get through the gold course, you will become you got it. You can successfully trade options, I think. You may not make billions of dollars, but you're not going to lose your shirt. If you can't, then you know what? The best gift I've given you is designing a course that teaches you that you should let somebody else trade your money. I think that's a gift. And I have no problem telling people, I mean this, I have no problem telling people that maybe they should find somebody else to do it. So the gold course is, the silver and gold course are beginner. If you get through the gold course, if you know you're going to want one-on-one work, then you should do platinum. If not, you can buy platinum later and do one-on-one work with me and Andrew. We do lots of individual one-on-one mentoring. And then, obviously, our pro group is for guys that are trading on portfolio margin.
So what is the difference between skew and term structure?
Okay. Who's that from?
It's from Rod.
All right, Rod. Skew is the relationship of options within a month. So if you were looking at December, skew would be how expensive are the S&P 500 1250 puts relative to the 1400 straddle relative to the 1450 or 1500 calls in terms of volatility. All right. What creates a skew is the 1250 puts might be a 25% implied vol. The 1400s might be a 17% implied vol. And the 1500s might be a 13% implied vol. That is skew. All right. Term structure is the relationship between months. So December at the money volatility might be, what did I say, 17. January might be 19. It might be 17. It might be 15. So term structure is the relationship between months, thus the word term, and skew is the relationship between the strikes within a month.
What's more critical to success, position sizing or knowledge of adjustments? And that's from Shane. That's from Shane, who also says he loves the book.
I appreciate that he loves the book. You know, position sizing or knowledge of adjustments. I would say they're tied. But they're, well, I would say probably position sizing. Believe it or not. Because if you size your positions right, no one position is going to completely blow you up. I actually find adjustments to be probably one of the least important things. I mean that. All right? Because you really don't need knowledge of adjustments. You need knowledge of options. Chris, I'm sure you agree with that. Because
yeah, if you have knowledge of options, then the adjustments become a lot easier.
Right, and this is what I keep telling people. Instead of trying to learn the strategies first, learn how the options work. Then overlay the strategy. It's actually really easy once you do it that way. It is unbelievably easy. Then it's all about just proper risk management. Now, Andrew, my partner, you know, it's funny. He and I actually have different roles now. You guys know I used to work for a firm called Group 1, which is a pretty large market-making firm. Well, Andrew taught the CEO how to trade, taught the guy who taught me how to trade, and was the managing director of the Chicago office. So whereas I get, multiple position management, his understanding of global position management is probably unmatched in the education business. And that's why we consider ourselves traders who teach. Because we still trade, which I think is a differentiator. That's one of the things I like about you, Chris. You're a trader who teaches. And so learn that foundational knowledge. Take that time, and you will be paid back. And I really appreciate the compliments on the book.
So here's an interesting one. If options are a zero-sum game, then why are so many traders so hyped about selling premium when there is no inherent advantage being a buyer or a seller of options?
Well, the interesting thing is there actually is an inherent advantage at any given time. And certainly in the SPX, if you ran a long-term historical, if you assume what the model assumes, that you can delta hedge continuously, then options are statistically overpriced about 2 to 3%. All right, that's what you're given. All right, now the truth of the matter is that 1, we can't really trade that way. 2, at any given time, options are going to be relatively efficiently priced. So the key is finding, what I like to say is at any given time, about 40 to 50% of options are overpriced. About 20 to 30% of options are underpriced, and the balance is relatively fairly priced. So, you know, I think there's any inherent advantage in just being constantly short premium? No, absolutely not, and certainly not from a retail trader's perspective. If I'm a market maker and I'm getting the bid-ask spread and I'm net short premium, and I'm selling premium, over time I'm probably going to win. Because you guys are paying that bid-ask spread, you're probably not in the same position as the professionals. So the key is to recognize a good sale from a bad sale. Even if you never buy an option, understand why someone will buy an option. All right? And if you never short an option, understand why someone would never short an option. All right? I can tell you, you can trade for edge, all right, and have almost no risk if you really know what you're doing. I know this because that's what we've been doing in our strategy letter. I think I answered his question, right? I might have gone off on a little tangent.
Yeah, you know, the one thing I'll add to that is, yeah, you know, there's a lot of retail traders out there that do things because they read stuff on the internet or in a book, and it seems to make sense. And in the absence of better knowledge, they buy into it. And
yep, that's exactly right.
And you know, if someone convinces you that you're better off selling options, and it seems to make sense, you're probably going to sell options.
Yep, and you're probably going to not make money.
You know, and there's good reasons to sell options, you know, and you know, so it gets a little bit more, you know, complicated as to why everybody does what they do. But
there are great reasons to sell options. But what I will say is, those who decide they want to be short options, all right, and are successful at it, those that run only premium selling strategies, and they are there, all right. The people that only run that are really successful at straight premium selling strategies came to that conclusion usually on their own, not because somebody told them that that's what they should do. All right. Now, Chris, I know you're primarily a premium seller. Did somebody tell you that that's what you should do, or did you read and then you investigated and then you learned and then you said this is the right thing for me?
That's exactly right. It took me years to figure it out.
Exactly. So if you're premium sell, if you've decided I want to be a premium seller because someone told you that is what you should do, mistake. If you became a premium seller because you said I really investigated options and I know how these things work backwards and forwards, and the right thing for me is this approach to premium selling, right? With this plan, that is you have a decent shot at success. You know, Dennis, my co-author that runs the hedge fund, our whole book was written on a short premium seller's approach. All he does is sell premium, and his fund does well. That is what I'll say there.
We got one person commenting that the link does not work. What I'll tell you is the link is case sensitive, so you do have to capitalize the S in Sebastian, and it should work for you.
Okay, there you go.
Now here's a question that I'm going to let you answer it, Mark. Then I'll tell you what I think.
Okay.
You said your book should be the 4th or 5th one to read. What are books 1 to 4?
Books 1 to 4. You know, there are a couple good introductory books out there. Wolfinger's book is okay. There's one other guy that's really good. Thomasette has a decent beginner book. Then read a book like Jim Bittman's Trading Options as a Professional. Then like Shelley Natenberg's book, or Shelley Natenberg's book, and then I have Larry McMillan's book as like a desk reference. And then read mine. Yeah, that's probably the order I would go. Chris?
Yeah, I'd say you know, there's several good primers out there. I just referred someone to Guy Cohen's book earlier.
Oh, yeah, Guy Cohen. That was the other guy I was trying to think of, actually.
I read all the wrong books when I first started getting interested in options because I didn't know what were the right books. But Guy Cohen does a pretty good job. From there, though, if you get through that and you really want to start learning, I think you have to have Larry McMillan's Options as a Strategic Investment on your shelf.
Mm-hmm.
I don't think you're allowed to trade options unless you have that one. And the same's probably true with Sheldon Nattenberg's book. You better have that one as well. And then after that, I think everything from there is kind of to your taste.
Well, you should obviously you left out my book.
We're talking about the ones leading up to your book.
Oh, okay, yeah.
So once you get through those your an initial primer, and I can't. Sheldon's book, Nattenberg's book, you can sit down and read that. McMillan's book's not a read.
Right? No,
it's not a page turner. That's something where you pull it off the shelf, and you have a question and you answer it. It's like a reference.
Yep.
And
I'll personally tell you, I've read when I got hired by Group 1. I got home and Nattenberg's book arrived in the mail that day from them, and they said, "Read this before you start." So that was one they really forced me to read, and I have probably read it 6 times, and at many different junctures in my career. I went back and would reread sections, and then and I still reference it. I really do. It's a phenomenal book. The one piece of advice I would give in terms of book buying is I found words like making money, profiting, returns, anything that involves a word that would be directly associated with money are usually books that I stay away from. Well, there's an exception or two. Profiting with Iron Condors is actually a pretty decent book. There's some things I disagree with him on, but Van Cleef's book is the only book I've ever read that had the word profit in it that I actually thought could help someone make a profit.
And probably most of what you thought would help make the profit was his advice on how not to lose your money.
That's exactly correct. Generally I found is most people, I can teach just about anybody how not to lose money. Making money a lot of times is a lot more difficult.
Yeah, the making money part kind of comes by itself if you're not losing the money. If you're in the market and not losing money, you're eventually going to make some.
Yep.
So let's see. Rudy's asking if we can provide a list of the books, and what I'll do is...
Tell you what, well, the list of the books are in the back of my book.
Oh, okay. Well, yeah, there you go. I was going to say I'd post them, but even better, go ahead and buy Mark's book, and you'll get his list.
Yeah.
But no, I'll go ahead. Actually, when I post the video of this, I'll go ahead and post a list of the books that we've talked about, like the Guy Cohen book and certainly Larry McMillan's and Sheldon Nattenberg's book.
Yep.
If
you want the slides, you can shoot me an email, and I'll happily send them. My email is mark@optionpit.com. And if you have questions about our service, let me give everyone my cell phone that you can call. It's 630-862-1152. So, the one thing, if you're thinking about taking education, generally speaking, I'm going to come in about 1/10 of the cost, somewhere between 1/10 and 1/3 the cost, and better quality. because I trade, and we're up on everything. Anywho, any other questions?
Bill was asking where you can get a link to the course, but I imagine if he goes to optionpit.com, you'll find it there.
Yep, optionpit.com/mentoring will take you to our list of coursework.
All right, and I think this will be the last one, and we'll see if we can deal with it without getting too involved. But Andrew says, if my trading plan only uses credit spreads, is it enough to simply set stop losses based on technical levels like support and resistance, as opposed to focusing too much on managing Greeks?
Well, what I would say is, if your plan is just, you're basically now is he selling call spreads and put spreads, or is he just selling put spreads?
I don't know.
So before we can even answer that question,
okay, Andrew says he's selling both calls and puts.
So what he really has on is a synthetic iron condor.
Right.
And so what I would say is that you should probably learn the Greeks, because one, you're constantly short Vega. So if the market blows up one way or the other, you're gonna get crushed. And then two, you probably want to make sure you're not overweighting your delta one way or the other. The one thing I'll say is that I really stress this is, if I put on a put spread, a bullish put spread, all right, the next one I put on sure as heck better be better than the one I just put on, all right, and so and if I'm looking to do something against it, I'll actually do it for a little worse, because I'm trying to balance out my portfolio. So what I'll say is the answer is yes and no. And I'm not going to get into a big discussion on technical analysis. But what I would say is that even with a strategy like that, you will be very, very happy that you decided to really learn options, even if you never change your strategy. It will make you a better credit spread trader, quote unquote. And I'm not going to get into the credit debit thing or talk tech analysis.
Yeah, no, and what I'll just go one step further, and I'll say, learn the Greeks. It's not even a maybe or.
And learn the price. In order to do that, you have to learn the pricing model.
Well, right. Understand how the pricing model works. Understand the synthetics, because if you're trading both call and put spread, as Mark already said, you're really getting yourself into synthetic iron condors, even if they are different underlying, securities. Andrew says he's only doing it on non-diversified ETFs as opposed to individual stocks. But if you get a market rally, most of the market's going to rally with it. And,
yeah, I mean, you know how, and in a panic, the whole market correlates.
Right. And
look at the implied correlation index and some of the different correlation indexes. In the flash crash and in 2011, the market correlated at something like 98%. So
yeah, because when people decide that when people decide they're really scared and they want to get out of everything. They want to go flat, and so everything goes down.
Yep.
But it's for me is if you're gonna trade options, take the time and figure out how these things really work. I mean, if you're gonna learn to fly planes, figure out why they stay up in the air.
Exactly.
If you're gonna do surgery, figure out how the human body works.
Yeah, you got to pass organic chemistry.
Yeah, and learn. I mean, if this is your business,
you got to do surgery on a cadaver.
Your goal should not be to be the least knowledgeable successful trader.
That's already taken. That's already taken anyway.
Yeah. because then you're just saying, you know what, I just want to be good enough and lucky enough to get by. I don't really want to have to learn this stuff, and I think you're just setting yourself up for an eventual fall because you're going to probably do okay for a while, selling credit spreads, because if they're out of the money, they're a high probability strategy, and
with the VIX at 15, you're going to do great.
Yeah, and then one day you wake up and something really crazy's happened, and your account's a lot smaller than the day before.
Yep.
So, okay. I think that's the last question we'll take for tonight. And if you want to get in touch with Mark, he's got his contact information up there. The presentation has been recorded, so barring any kind of technical snafu, I should have that up within a few days. And I will also include a link not only to the books that we talked about, but also to Mark's prior presentation on realistic rate of return.
Right.
And that should give you a pretty good place for kind of figuring out how to put together a trading plan.
Yep.
Especially if you have bought the book.
Especially if you bought the book.
All right.
So,
Mark, thank you very much for joining us.
Hey, thank you for having me, Chris. I always love coming onto your group. So, appreciate you for having me.
Well, we're very happy to do it.
All right.
You guys all have a very good evening, and thanks for joining us tonight. Good night, everyone.